Financial ratios are analytical tools used to evaluate a company's financial performance, operating efficiency, liquidity, solvency, and profitability. The program explains that ratios convert raw accounting data into meaningful relationships that help analysts compare companies across industries and over time. Because financial statements alone contain large amounts of information, ratio analysis simplifies interpretation by highlighting important trends and performance indicators. Investors, creditors, managers, and regulators rely on ratios to assess financial health and support investment, lending, and strategic decisions. Effective ratio analysis improves understanding of how a company generates profits, manages assets, controls costs, and finances operations while also helping identify strengths, weaknesses, and potential financial risks. Financial ratios are generally grouped into categories based on the aspect of performance being analyzed. Major categories include liquidity ratios, activity ratios, solvency ratios, profitability ratios, and valuation ratios. Liquidity ratios evaluate the company's ability to meet short-term obligations, while activity ratios measure operational efficiency and asset utilization. Solvency ratios assess long-term financial risk and leverage, profitability ratios evaluate earnings generation, and valuation ratios help investors estimate market value relative to earnings or assets. The program emphasizes that no single ratio provides a complete picture of performance. Analysts therefore combine multiple ratios to gain a broader understanding of financial condition, operational effectiveness, and long-term sustainability within different economic and industry environments. Liquidity ratios are important because they measure a company's ability to meet short-term obligations using current assets. Common liquidity measures include the current ratio and quick ratio. The current ratio compares current assets with current liabilities, while the quick ratio excludes less liquid inventory from current assets to provide a more conservative assessment of short-term financial strength. Higher liquidity ratios generally indicate stronger short-term solvency, although excessively high liquidity may also suggest inefficient asset utilization. Analysts compare liquidity measures with industry averages and historical trends because optimal liquidity levels vary significantly across industries. Strong liquidity helps companies withstand temporary economic difficulties, manage working capital effectively, and maintain operational stability. Activity ratios evaluate how efficiently a company uses its assets and manages operations. Examples include inventory turnover, receivables turnover, and total asset turnover ratios. Inventory turnover measures how quickly inventory is sold and replaced, while receivables turnover assesses collection efficiency. Total asset turnover evaluates how effectively the company generates revenue from its asset base. The program notes that activity ratios provide insight into operational efficiency and resource utilization. Efficient asset management generally improves profitability and cash flow generation, while declining turnover ratios may indicate operational problems or weakening demand. Analysts interpret these measures carefully within the context of industry norms, business strategy, and broader economic conditions affecting operational performance. Solvency and profitability ratios provide insight into long-term financial stability and earnings performance. Solvency ratios such as debt-to-equity and financial leverage ratios evaluate the extent to which a company relies on borrowed capital. Higher leverage may increase returns during favorable conditions but also raises financial risk during economic downturns. Profitability ratios, including gross profit margin, operating margin, return on assets, and return on equity, measure the company's ability to generate profits relative to sales, assets, or shareholder investment. Analysts use these measures to assess competitive position, management effectiveness, and operational strength. Comparing profitability and leverage ratios together helps determine whether earnings are sustainable and supported by appropriate levels of financial risk. Although financial ratios are powerful analytical tools, they also have important limitations. Differences in accounting standards, business models, seasonal patterns, and management estimates may reduce comparability between firms. Ratios also rely on historical financial information and may not fully capture future risks or strategic developments. The program emphasizes that ratio analysis should be combined with qualitative evaluation of industry conditions, management quality, competitive position, and economic trends. Analysts must interpret ratios within broader business and market contexts rather than relying solely on numerical benchmarks. A strong understanding of financial ratios enables finance professionals to evaluate company performance more effectively, identify potential warning signs, and make more informed investment, lending, and valuation decisions.